Hi, I'm Fabio Kuhn, the founder and CEO of Vortexa. Our session today here at the Reuters Commodity Trading Summit will cover new data sets, new lead indicators to help us understand and making decisions in this very volatile oil market. Very few periods in history we have experienced such extreme volatility like we have this year. And in the midst of all this volatility, there are challenges, particularly from a logistical risk management perspective. But also, on the other hand, some incredible opportunities that are very rare in the markets, in the history of the markets. So we're very excited to be able to show you today some new data sets that are just very recently possible to be generated using the very edge of technology applied to the commodities trading market. First, just a few words about our company. So Vortexa today has the most complete data on global waterborne oil and gas flows available in the market. We help our clients who are physical, financial traders, shipping companies make better decisions in the market, in many cases ahead of competition, in many cases capturing opportunities that otherwise wouldn't be seen. Our coverage goes from crude oil in all of its grades, as well as refined products, but also LNG, biodiesel, and chemicals. We can only do what we do with deep technology, but also deep domain industry expertise. We use data in a very large scale, coming from satellites, coming from industry sources and partners that we have. But we apply data science in a very extensive and large scale to be able to complete data sets when they are still not available, particularly in real time, particularly in the time that you need to make a decision. That's when it matters the most. So by combining data at scale with science, we're able to have this complete view of the market when you need the most. And that combination allows us to extract insights and provide our clients with the best available view in the market, particularly on the supply of oil and gas flows waterborne. And what a year 2020 has been for us. A market that was worried about IMO 2020 never saw COVID coming. And with COVID, we've experienced an oversupply of epic proportions, which led to a historical high level of inventory buildup. So in the middle of all this changes in the market, we also experienced quite a lot going on geopolitically. So we had US-China trade war, we have OPEC interventions, and now recently the US election. So all of this have created a trade environment that is extremely volatile. This year, floating storage has been a formidable indicator to help us understand the degree of oversupply in the oil markets. It's a type of storage that is relatively expensive, so tends to move faster to signals in the market. And it is also very connected globally, so it allows us to see the balances in its full form as well. So when we look at the prices of oil, particularly Brent here, with floating storage, we see that as we are reaching record high levels of floating storage, the oil prices have collapsed, particularly mid-March and April. Floating storage, it went up to 200 million barrels of oil sitting on tankers, going nowhere. And since then, it has come down, significantly. We're still at very, very high levels of floating storage, but the rising of floating storage during that period was where one of the biggest signals that we saw, this year for the market. As the market rebalanced, we saw a drawdown in floating storage that also indicated, that the situation is not as oversupplied as before, but nonetheless, at very, very high levels still. It is a market that is substantially overhang in so many ways. Now let's break floating storage in different ways. We can break it based on location, so regional, time, as well as products, and we're going to see that in the next slide. Here, we're looking at global crude floating storage across regions. And we saw that Europe peaked in May, and since then has started to come down, particularly in July and afterwards. While in China, in Asia overall, but really driven by China, we saw a significant build-up that was a result of a buying spree of crude that took much longer to rebalance. And the difference between regions are very important for the economics of the arbitrage trades that are existing across locations that lead for physical traders to move energy from one place to the other. So understanding the regional breakdown is key for that trade, which reflects on financial contracts associated with those pricing points as well. And so when we look at different time frames, we classify floating storage sitting on a ship for more than 7 days in a stationary pattern to be a short-term floating storage. More than 30 days, we associate to a long-term storage. And understanding the difference between the two allow us to have a better understanding the structure of the market and how traders are positioned themselves in the different, I'll say, durations of trade. And when we go across products, particularly refined products, we saw, again, levels that are historical record highs. And particularly when you look at Europe and Asia, we saw some very, very extreme moves in refined products. And in Europe, which is a very strong diesel demand center, we saw quite a big variation there on both the build up and then on the drawdown as the market rebalance. But the floating storage here brings to us a very close indicator or the impact on demand. Those are faster markets. The floating storage is also tends to behave very similarly, acting very quick once the demand is not there or has returned. So we've been watching this breakdown very closely. And we saw here clearly in Asia as well, when the economy starts picking up, how the floating storage goes very, very quickly as a result, across, diesel, jet, and gasoline. So when we look here at the situation in Europe now, we see still a massive level of floating storage in diesel and jet. And now with the evolution of this second wave of COVID here, this is a particular point, a particular indicator that we'll be watching very closely to see if these levels here continue to rise or not. And that would allow us to understand the impact of the second wave of COVID that is happening here in Europe. And of course, those levels have a direct impact on price of those products on a regional basis, especially for refined products. Now let's talk about flows and the arbitrages that lead them to exist in the first place. When we look at the imports into PADD 1, particularly New York Harbor, and the ability to anticipate what is being reported officially has been quite a strong source of tradable signal for many of our clients. And that could be hedging trades, that also could be proprietary, more speculative trades in the financial markets. But it does play out to the physical dimension as well of the trade. So by anticipating and predicting that really closely with very high levels of correlation, we're able to help our clients anticipate the market by several days. And we can see that when we connect as well with the level of stocks in PADD 1, and we compare that with the departures from Europe, so we can understand as well how the stock levels are going to be quite a few days ahead, which is very important for the dynamics, particularly on the futures market. This is only possible by not only picking up every single cargo coming from Europe to the US, but more importantly, understand if they're actually going to go there, because many of those cargoes can be redirected at any time, can diverge anytime somewhere else. And so the ability to pick those up instantaneously as well, it's quite important for us to have this number here accurate for our clients to make decisions in the market. Trading signals can also come from unusual patterns. And here, what we're seeing is a very unusual, especially in an early reverse arb between Europe and the US. Europe is usually a net importer of diesel. And here what we're seeing is diesel actually coming from Europe to the US. Usually it comes the other way around. And that is a bearish signal for the diesel markets in Europe. The amount of oversupply has been such that this trade was possible in the physical markets. Now I'd like to talk a bit about freight. Freight is a very important component of a physical trade. That is what allows those arbitrages to happen. And there is a very strong link between the rates and the ability to do physical arbitrage, but there is also a very strong link between the availability of freight and the rates, as one would imagine. The ability to calculate this availability of ships in real time and very close to what is happening in the market allows us to anticipate the freight rates, which then allow us to understand also the ability of arbitrages to happen across different parts of the energy markets. So here's an example of an MR, which is a class of tankers, particularly in the Houston, Mexico, area, where we can clearly see here the availability of ships coming down, particularly in many cases actually for the user in floating storage, and what that has led to prices. And we saw a spike of prices here in April that has been a direct result of the lowest levels of availability on this class of ships, which typically carry refined products. And after that, obviously, the continual correlation between those two. So the ability for us to be calculating this continuously is key to understand not only the freight markets, but also what is possible on the physical markets. Here's another example in a larger scale, and particularly related to the crude market. The relationship between the rates of the VLCCs or VLCCs is very closely linked then again with the availability in utilization, in this case here, of VLCCs. Now, this is all very known and understood from a market perspective. The ability to have this continuously and in real time is what is the major breakthrough here that allows us to make decisions faster, even before that in many cases, the rest of the market understands. How fleets are utilized is also very important. So by breaking down the utilization of in-transit ships, we're able to understand very closely how the ships are being used to fulfill the demand of different markets. And the change in that level of utilization is a signal that the market is pulling products, is pulling, let's say, the movement of energy from one place to the other. And that's very important for both freight and physical energy trading market. So in summary, the frontier of new real-time data for commodities trading is opening a whole new spectrum of trading strategies that were not possible before. And here I'm talking as far as a few months ago, not possible. So In a world that is surreal with COVID and one where we're experiencing extreme volatility, it's very exciting to have a new dimension of data to be able to identify and capture trading opportunities in the market. And as a result of all of this, we are making the global commodity markets better and more efficient for society. So thank you very much for your time today, and I look forward to working with you.
Thank you, Fabio, and I'm delighted to go live with Fabio Kuhn at Vortexa. We've had a couple of questions come in already, and my first one really, Fabio, from myself is, you talked to floating storage. Could we see another build-up in floating storage if demand conditions remain weak?
Yeah, I mean, it's very possible that the floating storage could rise again, but never, I believe, the peak that we've seen earlier in the year in March and April is probably behind us, as in it's unlikely that's going to reach the same levels. It caught the market overall by surprise. You know, the COVID distortion has been one where the market has learned from and adjusted its supply chain, its way of operating, its way of managing, you know, our current situation. So it is possible that weak demand bring to higher levels, but probably not as high as it has in the past.
Got you. And you touched on it there. Do you think floating storage has peaked?
Yeah, I believe so. I mean, you can never say never nowadays, you know, because the market is at unprecedented levels of volatility, but, you know, it's unlikely that we'll see the same levels that we saw in March and April. It is one to be watching very closely, though, because the market has adjusted, it's also a more sensitive figure now. So if it does go up, it does have a more significance than even it had initially before, because the market has adjusted. So going up means, you know, things are getting really, you know, oversupplied, you know, even more.
No, very good. And then actually this next question sort of sets up the following panel actually quite nicely, but from a technology point of view, do you feel the relationship between freight and energy markets are getting stronger over time?
Yeah, it's definitely, we've seen the link between freight markets and energy markets getting stronger. And the main reason for that is that the margins on commodity trade, physical commodity trades have been narrowing and thinning over the last few years. And so freight has become more than before a factor that makes or breaks a trade. So the understanding of the freight markets actually means that you can understand the physical arbitrage. And if you can understand the forward view on freight, you can also understand where physical arbitrage will open, you know, down the line as well. So it has become a more significant factor as the commodity, as it became now a part of the feasibility of a trade.
No, very good. And I'm conscious we talk volatility. It's a key theme through this morning. I know also Clay Siegel, your MD for the Americas, is joining us again tomorrow with BP and EIA in a conversation around this exact point. But I guess a final question to leave people with, you know, what would you say are going to be the most important indicators to watch going forward towards the end of this year, and then also as we enter 2021?
Yeah, it was very good question, Luke. And in addition to what we discussed here in floating storage and freight markets, one of the particular indicators that we're watching very closely is the volume of in-transit flows of energy products, and especially, you know, refined products. If you look close to the demand of the market, so we see that the increasing or decreasing that flow can be quite a strong predictor of the health or the state of demand, and they tend to react relatively, you know, quickly to it. And together, floating storage creates quite a good picture for us to be able to understand what's going on in these very volatile markets that we're living in.
No, thank you, Fabio. And I guess when we talk volatility, to quote Torben earlier, I think we just keep smiling, which is a great piece now to Fabio. Thank you very much for that. Great to have you live. Thank you for your time.